human beings can also be very smart. Oops. No. So here's the thing, it's called risk-based capital. How much capital should a bank hold? Well, it depends on how much risk the bank takes with its investments. Prior to Basel, they would say you had to hold a certain amount of your assets in reserves. It was a percentage, okay? So every bank across the board, they might say if you have to hold 10% of your assets in the form of capital that's set aside, very liquid, very safe investments. And one size doesn't fit all, because it didn't discriminate or distinguish between banks that had risky assets and banks that didn't. Everybody had to hold the same percentage. And that's not smart. For a bank that takes more risk, they should have to hold more capital. Okay? And of course, the banks, they didn't like this idea at all. Okay? Why would a bank take on more risk? Why does anybody take on more risk? Not because it's a rush. Why?
Higher return.
Make a higher return. Okay? So the whole point of the regulation is to protect the stockholders and the depositors and the economic system, to make sure that the bank has enough capital to keep it from going bankrupt. So banker, if you want to get into risky business, and that's what happened in the 2000s, the first decade of the 2000s, then you have to hold more capital. All right, it's a great idea. Basel II, 2004. Further refines the definition of what capital is. Okay? How can you hold your capital? So first, the amount of capital you require is based on how you invest your assets, but now, what is it that we consider to be your capital? What can you invest your capital in? All right? Every time a rule or a law is made, people spend lots of time trying to figure out how to get around. Okay? I loved it watching Ford versus Ferrari. Anybody see that movie? I loved it, man. I hated the name, Ford versus Ferrari. I'm like, I'm not interested in watching that. That sounds like the Fast and the Furious or something like that. But it's not. It's a business movie. Okay? One of my favorite scenes was when the Deuce, remember the Deuce? Ford Jr. calls Matt Damon in after they got their butts kicked the first time at Le Mans. And he says, the Ford says to Matt Damon, why should I fire you? Y'all did a terrible job. He goes, well, while I was sitting out in the lobby, I saw the report that's on your desk right now. I saw it change hands 4 times. That's why we failed. Because you got this big behemoth of a bureaucracy going on. We can't get anything done. And that's very true in business today. If you are a standout person in business, there are a few people who are going to love you. And the rest of the people are going to what? They're going to hate you. Why? Because they're going to be threatened by you. They're going to be threatened by you. It's human nature. It's not business. Oh, business is evil. It's not business. It's human nature. If you stand out and do your job, and you tell the emperor that he ain't got no clothes on, then you're going to be a marked person. You're going to be really careful. It's sad. It's sad. All right. All right. It breaks capital into Tier 1, Tier 2, and Tier 3. Okay? So how is your money, is the money that you're setting aside to protect the bank being invested? Tier 1 is the strictest definition. Okay? It's owner's equity. What is your capital? Your owner's equity is considered to be capital. Then you have your long-term loans, and then your short-term loans. and that's considered to be your capital. Then you're looking at your assets. Okay? So they're adding more detail to keep people from finessing the rules. So you look at the credit rating of each asset. The lower the credit rating, the riskier the asset, the more capital you need. You've got to have more money in owner's equity, more money in long-term loans, more money in short-term loans. Okay? And it refined the reporting that banks had to do so that the regulators or examiners could stay on top of what was going on at your bank. Now you could still get around it by committing fraud, by lying. You can lie. All right, Basel III. Once again, they keep going back in and saying, we're not making you guys hold enough capital. Okay? And one interesting thing they did is that when banks are being very aggressive with their loan portfolio, okay, then they have to add more capital. Okay? So they're looking at bank practices and strategies, and they want to make sure that they keep up. So anything that adds risk to a bank's operation, okay? And see, investors see the bank growing fast, and they get all excited. Hey, the loan portfolio is expanding rapidly, okay? And they get excited because that means that the bank will make more money on their loan portfolio. They keep. How do you make money? How do you make money on your loan portfolio? Well, again, first you got the spread. Okay, so let's say you pay 1% on your deposits. Okay, and let's say you charge an average of 6% on your loans. Okay, so the spread is 5%. Okay, which is a 500% markup, which is really nice. Okay. But what if you only have $100 in loans? The bank's only going to make $5. So the spread is nice, but the amount that's being loaned isn't high enough. So what if you increase that to $1 million? Okay? So banks focus on this and on this. Okay? Now, if you want to grow your loan portfolio from here to here, okay, one thing that you have to do is increase your deposits. How do you fund the loans? With your deposits. Okay? So, and how do you increase the amount of deposits you have out there in the system? Well, you either make people feel safer, because the deposits are out there, all right? Then people have to choose the bank. The deposits are there, and you decide you've got $300 in deposits, and $100 of that is going to a loan, fund loans. Well, now you want $1 million in loans, so you're going to have $300 million in deposits. And it's out there, you just got to get it. Well, how do you get it? Well, how do people choose their bank? Safe, advertising, okay? More importantly, this right here, the rate you pay. Okay? So your spread might go down, okay? But if your loan base goes up, you can offset that in even more. Okay? So it's strategy, but if you grow this real rapidly, okay, then Trump put a travel ban on Muslim-dominated countries. Biden just rolled that back. Okay, Why did Trump do that? Is it because he hates Muslims? Oh, you're a Muslim, I hate you. Is that why? Is that why he did it? No, that's not why he did it at all. Why did he have a travel ban from Muslim countries? There's one reason only. Security for the United States. Because that's where the terrorists are, people. Sorry. Okay. Oh, you're saying all Muslims are terrorists? No, no. But when you look statistically, we know where they were coming from. That's why. Oh, that's hateful. Whatever. Whatever. Wasn't trying to be hateful. He was trying to protect you and me. Okay? So, if you open the floodgates to this, what can happen? Bad loans. Bad loans can happen. In order to grow from here to here, you might have to cut some corners. So things might get by you. So an astute investor does not stand up and yell, "This is awesome." You have to be more circumspect, more prudent, more responsible. This very well could be awesome. Let's check it out before we get carried away. Okay, I used to do research on banks. I used to write research reports on banks, which is why they asked me to teach this class. And one thing you look at is their loan portfolio. Their loan portfolio. We had a bank in Arkansas, Worthen Bank, that got into trouble, and we're going to cover in more detail the bank assets. But this bank invested in a repo with a financial firm. And the repo was supposedly collateralized by U.S. Treasuries, which meant that if a repo is a short-term loan. So Worthen Bank said to this financial company, "I'll make you a short-term loan. And in return, you'll pay me a certain interest rate on the loan. And it's very short-term. It's only going to be for like a week. Okay? And you have a portfolio of U.S. Treasuries. So if your bank, which we know is teetering on financial distress, gets in trouble, we have collateral. You have to pay us with those Treasury bills." What they didn't know was that that bank had promised those Treasury bills to another bank. Okay? It was fraud. So they had a $50 million loss. Okay? And it caused the stock of Worthen Bank to go down big time. And so a bunch of silly people in Arkansas felt so grateful that Stevens bailed out Worthen Bank. Okay? Stevens didn't bail out Worthen Bank. They bought it in a fire sale. You think Stevens did that because they were good community citizens? No. They saw a bank that was worth $8 or $9 a share, and they bought it for $2 a share. All right? But what happened in the following 2 years was they brought a guy in who looked at Worthen's loan portfolio. And Worthen lost like $200 million on their loan portfolio. No one ever talked about that. All they talked about was that bad repo deal. But Worthen had a terrible loan portfolio that had to be cleaned up. And Stevens kept that really, really quiet. They didn't want people to talk about that. And I wrote about it in a research report, and I got cussed out by the CEO, Stevens, who's still there. He didn't like the fact that I pointed out that the loan portfolio was really bad. It wasn't Stevens' fault that the loan portfolio was bad. They just didn't want the public to know about it. All right. Okay. So Basel III introduced a leverage ratio that keeps banks from borrowing too much in an effort to grow their asset base. Because banks will fund loans either through deposits or by borrowing money themselves. The bank can borrow money, okay, and the bank will borrow money at a certain rate, say 4%, and they'll loan it out at, say, 7%. It's still a nice spread. It's not as nice as that, But as long as they can make a spread that's adequate, they're earning a rate of return on their loans that makes them money. So what Basel says is, we're watching your leverage too. We see you issuing bonds. A bond is a loan, okay? And we see you borrowing from other institutions, and you're taking that money and you're reinvesting it in loans, okay? And we're not saying that's a bad business strategy. We're just saying we're watching. We see it. It's risky, okay? And it might work out for you. All right. So Basel III required banks to hold high-quality liquid assets to cover near-term cash outflow needs. All right. And it put a limit on how much, percentage-wise, how much banks could borrow. They're saying deposits tend to be stable. Loans that you, or borrowings that you have are not. So we want to see you fund your loans through safe deposits. All right. So, again, this last part, selling mortgages to the Federal Home Loan Bank System. Banks were selling one asset in order to, so let's say, it's a similar thing. Let's say the bank had originated a mortgage or had bought mortgage loans, and they were earning a spread of 2%. And they could sell those loans to a government agency that was buying the loans, and then taking the money they were getting from the government agency and earning a spread of 3%. You say, well, it's only 1%. Really? What's the profit margin on that? The increase in the profit margin. You just increase your profit margin 50%. You went from 2% to 3% on the spread. That's an increase of 50%. And it's not an increase of 1%. It's an increase of 1 percentage point on a base of 2 percentage points. That's a 50% increase, okay? But what if the agency decided not to buy any more mortgage bonds or loans? You'd be in trouble. So they're saying, we see what you're doing, and it's okay as long as you build a fence around it. Okay? Moderation in everything. Okay? Moderation. Okay? Harding has a real bad habit of having this, particularly when it comes to presentations and meetings. They think that if a little bit of something is good, then a lot of it must be really good. And it's not. It's not. There's an old adage, keep them wanting more. Leave them hungry. Okay? Still wanting more. All right. So, so who competes with the banks? And didn't we cover this once already? Chapter 1. Credit unions. And this is who regulates them. I'm sorry. So every one of these groups has regulators. Savings and loans, sometimes called savings banks, sometimes called thrifts, sometimes called savings associations. The book's not real clear about that, but they all mean the same thing. They're S&Ls. They're lending institutions. Okay, they have deposits, and their charters are a little different. They tend to be more local, and they focus on mortgages. That's what they were created to do. Mortgages. Commercial banks were more focused on business loans. And savings and loans were more focused on mortgage loans. Okay? But as the rules evolved, you couldn't tell one from the other. And I wish they wouldn't even have this savings and loan nonsense. Okay? Same thing, you got state commissions, and then you have the comptroller of the currency. It's just a type of bank. That's all it is. All right, then you have money market funds. Okay, They are not savings accounts. And when you sit for the Series 7 licensing exam, that's one of the first things you learn, is that a money market fund is not insured. It's a mutual fund. Okay? It's not the same thing. They're not insured. All right, they are regulated by the SEC. Mutual funds are regulated by the SEC. Okay, life insurance and property casualty insurance companies are regulated by the state. It's a state-by-state thing. Now, as business has become more converged and more complex and larger, the federal government has jumped in to regulate. Okay, particularly when there's convergence and you have an insurance company that is involved in banking and in investment banking, then the Federal Reserve will jump in. So again, in the old days with the old laws, you had 3 separate and distinct businesses. You had commercial banking, and you had insurance, and you had investment banking. And they stayed out of each other's way. But the laws and rules evolved, and all of a sudden, they all do the same thing. Okay? And so, you know, you've got a myriad of regulators. All right, finance companies, not regulated nearly as tightly. Okay? So these are more specialty companies that loan for specialty purchases, like equipment purchases, car loans, okay? Like a GMAC or GE Capital, which doesn't exist anymore, almost took down General Electric. It was so interesting. General Electric was an industrial company, and they started to grow. They saw how great the profit margins were in finance, and so they started buying financial companies, and they grew that subsidiary and called it GE Capital. And the analytical community went nuts. They loved it. And investors went crazy. They bought the stock. And all the bad stuff that could happen did happen. And that wonderful source of profits almost bankrupted the whole company. Okay? It's, you know, it's kind of, again, people just get kind of crazy. You know, people get caught up in things. And one of the things that's so scary to me, and what I see in my business, is people who don't understand what they're doing jump into businesses. And it's one thing when they risk their own money and capital, their own personal stuff, but then they start talking other people into doing it too.